Welcome to the Lend Academy podcast, session number 27. This is your host, Peter Renton, founder of Lend Academy. So today on the show, you probably will notice the sound is a little bit different. That's because I'm not using my regular recording equipment. I'm actually here on the road in New York City recording this edition of the Lend Academy podcast. And the reason I am is I'm here at the AltFi conference, and I wanted to get one of the speakers here, Cormac Leech, who is our very first ever returning guest on the podcast. I wanted to take him aside and talk to him about the state of the industry. He gave a keynote presentation earlier today. We talk about some of the things he mentions in that presentation. You know, we talk about the big deal that's happening in the UK right now with the government considering opening up peer-to-peer lending for ISAs, the UK retirement accounts. We talk about the industry both in the UK and the US, and we look into his crystal ball and talk about where the industry is going. So hope you enjoy the show. Thank you. Welcome to the podcast, Cormac.
Hi, how are you?
I'm great. Okay. So when we get started, just with giving a bit of background about yourself so people know who you are, who missed the last podcast.
Yeah, sure. So my name is Cormac Leech. I work at Liberum. It's an investment bank based in the UK primarily, focused on marketplace lending and other financials. Been a banks analyst for the best part of the last 10 years.
So are you still, when we last chatted, you said that you really been spending most of your time in this marketplace lending sector. Is that still the case? Is this the focus of what you do on a day-to-day basis?
It is. I kind of quite like personally to spend more time looking at banks, but management at Liberum are very bullish on the space and frankly been encouraging me aggressively to focus more and more on marketplace lending because they see the revenue opportunity.
Okay. So what have you been working on what are you working on lately? What's some of the things that you're doing?
Yeah, so we've been very active building relationships with a lot of marketplace lenders out there. Interestingly, we've also started to take some investments with our own capital in a couple of platforms in Australia. And we're also working in terms of some innovative structures that I probably don't want to go into too much detail on. But suffice to say, we're actively trying to create value by structuring opportunities in the marketplace lending sector.
Okay. So then let's just talk about the sector in the UK. I mean, we're coming towards the end of the year now. How do you feel like the sector has developed this year? What's changed over the last 12 months?
Yeah, I think the sector, the CEOs of the marketplace lenders in the UK, I would say they've become a lot more confident. There's certainly a lot more institutional capital chasing the sector. I think, they've quite rightly kind of been willing to go up the risk curve a little bit and generate more attractive net yields. And frankly, we're seeing some of them start to create interesting JVs with, point of sale companies and so on, creating value. So I would say they're getting more confident and more creative.
What can you give us an example of that, of working with a point of sale?
Yeah, I think an interesting one would be RateSetter's relationship with giffgaff, who's a provider of mobile phones to primarily the student space. But as I understand it, RateSetter provide the financing for the actual handsets. And this is a clear win-win, and RateSetter thereby builds a relationship with students at the right point in the life cycle, so that they become repeat customers, and it's a very efficient customer acquisition strategy for RateSetter.
So are these still relatively low yield short-term loans? I mean,
they are, but what we're interestingly seeing is that with the arrival of institutional capital, the Marshall Wace P2PGI fund, the consumer finance platforms in the UK are actually making higher risk, higher return loans available to the institutional capital. So you're actually seeing that the blended net average yield on the platforms increasing because they're basically opening up to these higher risk loans.
Interesting. Okay. I want to just talk about a little bit of news that came out in the last couple of weeks. RBS is one of the big four, big five banks in the UK, and they made an announcement that they are getting, they're really going to get involved in this sector by starting up a peer-to-peer lending platform or partnering with somebody. What can you tell us about this announcement?
Yeah, I mean, we know for a fact that RBS have been looking at the peer-to-peer space. I met the CEO of RBS about a year ago, and he definitely gets the opportunity. We know they've been in discussions and exploring it, but frankly, I think that this story in the FT is actually a non-story. We think, someone heard a rumor and treated it as factual. And in fact, there's very little substance. I think, unfortunately, RBS and the other banks will be hamstrung by their own slow decision-making processes and just won't be nimble enough to get a platform up and running, in the near future.
So you don't think any of the major banks in the UK are going to do anything? What about some of the smaller banks? Are they going to be? I know that the UK is dominated by these large banks. Are banks going to get involved like they've done? You've got Santander, but is there anything else on your radar?
Yeah, I think amongst the UK clearing banks, Barclays is probably head and shoulders ahead. They've been actively collaborating in terms of this Innovate Finance accelerator in the UK. More broadly, if you look at HSBC and Standard Chartered, actually, Peter Sands, the CEO there, was really quite bullish on this whole, alt-fi space. And we know that, Standard Chartered have actually been working in Asia in terms of, looking to partner with some peer-to-peer platforms out there. So I would encourage people to think about Standard Chartered as probably ahead of the pack in terms of embracing alternative finance.
And how do you think a bank is going to get into this sector? Are they going to just partner with somebody? Do you think a bank will ever create their own division that's going to be a peer-to-peer lending division? What do you think? How will they do it?
Yeah, I was having this debate with someone today. I think in theory, you could see a bank set up a skunks work, deploy a special team and create their own platform. In practice, the basic view is that, banks would really struggle to find the right personnel. And then because of politics and so on, would really struggle to get it up and running. So in theory, it's possible, but in practice, I don't think you'll see it. Right. I think that, they will continue to use the kind of model that we've seen with Union Bank, and I think is it Titan Bank that you interviewed previously, of, basically using the platforms as a cheap way to acquire, attractive risk-adjusted returns.
Right. Okay, fair enough. So there's some more big news that happened in the UK recently, and the UK government is beginning a consulting period for including peer-to-peer lending in ISAs. Can you explain what that is and what the process is going to be like?
Yeah, I think it's really interesting. I think the UK, I was just talking to some people today actually at the Alt-Fi conference in New York. The UK government is embracing alternative finance much more enthusiastically than virtually any other government I'm aware of. George Osborne, the Chancellor, has gone on the record saying he wants the UK to lead the fintech revolution. And as part of that, they are looking to open up the opportunities of alt-fi to savers, both in terms of individual saving accounts, which are basically tax-free wrappers that enable people to save, efficiently, but also in terms of pension assets. So the ISA consultation process is part of that. If they figure out how to set the rules and regulations, then in theory, the whole ISA market, which is somewhere around 450 to 500 billion pounds, opens up to peer-to-peer lending. And, if you assume, let's say 10% of that moves into peer-to-peer over time, you could see about 50 billion of balances in the marketplace lending space in the UK. Now, that presents a very significant problem in my view, because, if you think about the available assets in the UK versus the available capital chasing those assets, there's a massive imbalance. And frankly, I don't think that you can balance up supply and demand until you have a peer-to-peer lender aggressively tackle the mortgage market in the UK. And I think LendInvest is the most interesting platform focused on that space currently. And I think if they crack the mortgage market, I think, they will see a huge amount of capital, ISA capital, pension capital move into the mortgage space in the UK.
Is that because it's lower risk or why the mortgage market? Is this because it's bigger?
Well, I've asked some of the platforms in the past, and what they say is that the banks actually take the mortgage space more seriously than the consumer finance space. So big banks do mortgages better. And I think people just have behaviorally, typically gone to banks to get a mortgage, and people haven't really got their head around the idea that you can just go to the internet and actually efficiently find yourself, let's say, a £400,000 mortgage by going online. I think the penny just hasn't dropped yet in terms of, that actually being possible to, the average Joe public.
Okay, so let's just go back to ISAs. So, I know the UK government, there's very strict rules about what you can include in those accounts. So when they presume they go through this consulting period and they say, yep, everything's good to go, is it going to be every platform? Is it going to be on a platform by platform basis? How's it going to work?
Well, it's interesting. I think it's still consultation period. I think they're going to create a separate asset class. So you typically had cash ISAs and equity ISAs. I think there's going to be a peer-to-peer ISA. I think, the platforms which are FCA regulated, one would assume would be eligible to go into an ISA. And we expect, there are lots of different ways to create these ISA funds. I mean, we'd expect the platforms themselves to create individual ISAs dedicated to those platforms in particular. But we'd also expect the likes of Hargreaves Lansdown, which is a large, stockbroker wealth management portal in the UK, to also provide a competitive ISA proposition for peer-to-peer lending. So there will be lots of different kind of shapes and sizes of ISA products going after peer-to-peer lending. And, I think it really does create a very interesting investment option for the public in the UK in the near future.
Okay, so one of the things I know people here in the US talk about is risk. And particularly when it comes to retirement accounts, people want to maintain their capital. They don't really want to risk loss of capital. And in your presentation today at AltFi, you talked about Zopa's returns during the financial crisis. And so I guess what I'd like you to do is sort of tell us what those returns were. And also, if we were to have another financial crisis, do you think those returns would hold up?
Yeah, it's a good question. I mean, I think that the net yields during the last financial crisis for Zopa in the worst point were 4.5%, which is a remarkable return. I mean, you look at the S&P that year, I guess was down, check the numbers, perhaps down 50 or 60%. So, as an asset class, consumer finance performed extremely well. I think given that, the net yields currently for Zopa, I think are around the 4 to 5% per annum level. I think if there was an aggressive recession from this starting point, you would inevitably see those net yields come down. But I think they would still stay positive, perhaps 1 or 2%. Of course, it really depends what the nature of the crisis will be. But I would expect Zopa to frankly outperform virtually any other marketplace lender in the UK, with the possible exception of Lending Works, actually, which you may know has insured some of the credit risk with an insurance company, where people, don't pay a loan because of death or, more relevantly, high unemployment, then the insurance company will step in and absorb the loss. So with the exception of Lending Works, we think Zopa for uninsured platforms would probably outperform virtually the rest of the sector.
Okay. So actually that's a really interesting point. Can we just talk a little bit about that? Did they partner with a large insurance company, and how, are they going to be, do you know how the process works?
I don't understand in detail. Basically my understanding is that they've developed a relationship with an insurance company whereby if a particular loan defaults due to death or unemployment, then the insurance company will step in and absorb risk above a pre-assigned provision fund, right, which has already been put in place.
Okay.
But it doesn't protect against fraud risk, or there's the can't pay and the won't pay. It doesn't protect against the won't pay. The guy just doesn't want to pay the loan back. You can't protect against that guy, right?
Right. Yep. Fair enough. Okay. So then let's talk a little bit about transparency, because I know that's something that we talk about a lot here in the US, and you can go and download every single loan that Lending Club and Prosper have ever issued. And the same is true like with Funding Circle in the UK. Well, how is transparency viewed in the UK, and why is it important?
Yeah, I think transparency is very important, and unfortunately is increasingly sadly lacking, I would say, amongst the UK platforms. For example, if you look at Wellesley, RateSetter, or even Zopa, it's quite difficult to get a precise fix on, as a retail lender, who the borrowers actually are and what kind of credit risk you're actually underwriting. Now, this may not be a problem for the likes of Wellesley or RateSetter or Zopa, but longer term, there, in my view, is an increasing probability that, let's say, a more aggressive new platform emerges and is willing to write a lot of very high risk loans, but position them as being low risk and only offering retail investors, let's say, a modest, mid-single digits yield against that risk. And, there's massive potential, in my view, for the sector to be set back, let's say, a decade, perhaps, if one of these platforms were to blow up. And then there would be a contagion effect to the rest of the sectors where, retail money and the regulator would just, clamp down or move away from the sector.
Right. No, that's a very good point. It's a very good point. Okay, so another thing I wanted to touch on from your presentation, you talked about a $250 billion market cap for the entire sector in 10 years. Is that the UK sector, the European, is that UK, US? What was that, and how do you come up with that number?
Right, so that was a preliminary estimate of the equity market cap for US and UK marketplace lending. And I would say it's conservative because, I mean, for starters, it excludes the whole invoice factoring space. And, it's based on relatively conservative assumptions in terms of market share. I mean, it's assuming, let's say, a 10% market share in mortgages, perhaps around 25% share in SME lending. And, based on what some of the stuff we're hearing today at conference, there's increasing confidence that market shares could actually go above those levels. That said, $250 billion is quite modest in the context of the current market caps of banks. Yeah. I think what's going on is, frankly, marketplace lending is a very efficient way of intermediating between savers and borrowers. And, the flip side of that is that, you would expect the market cap of the sector to be less than that of the banks because you're capturing less of the revenue pool of the economy. So you're freeing up resources and profitability, to shift elsewhere in the economy. And so I would argue actually that, kind of a relatively modest market cap of the sector is actually a good thing.
Okay. Because, I mean, the banking sector, just in the UK alone, would be many, many times that, I imagine.
Yeah, I think if you look at the European banking sector, you're looking at something around €1 trillion. I mean, don't quote me on that, but I think that's ballpark, the order of magnitude. And then globally, you're probably looking at, I would argue something around $3 trillion. Okay, so you think maybe 10%, roughly 10% of the market cap would be in 10 years' time marketplace lenders? I would say, and I guess it comes down to what market share they can actually capture. And I would argue that there are lots of other adjacent spaces in financial services. You've got the whole payment space, foreign exchange space, insurance space, which are still largely untapped. If alternative finance moves into those sectors as well, that will be an equally large revenue opportunity, and it will imply a larger sector market cap.
Right. Okay, let's talk about the first publicly listed entity in the UK, which is P2PGI. They've got what's really a closed-end fund. You call it an investment trust there. They're trading right now. Anyone in the UK can go and buy shares in this investment trust. Can you just tell us a little bit about it, what they do and who they invest in?
Sure. So P2PGI, the ticker is P2P. This is a closed-end investment trust with a market cap of initially £200 million. And was set up as permanent capital to be deployed on peer-to-peer lenders, really globally, but initially primarily in the US and the UK. So it started off obviously 100% cash back at the end of May. At this point, it's actually about 46 or 50% deployed in terms of the cash put to work on platforms. Also, there have been some small equity stakes taken. What's interesting is that the P2P, it actually trades at a premium to NAV, which is very unusual for a business which is, still 50% in cash. And, we would argue that as it becomes more invested in peer-to-peer loans, that the price to NAV will increase further. And actually, it's entirely consistent with our view that the cost of capital for peer-to-peer loans is actually well below the yields that are available. So in principle, you would expect when P2PGI becomes fully invested that it would trade at perhaps 1.4 or 1.5 times price to NAV. Currently yields about 8%, and we think it is an attractive investment at these levels for relatively risk-averse people because, frankly, I think it's quite a cautiously managed fund.
Okay, so you cover this officially at your company, right? You cover this closed-end fund. So, what you're saying is that the yields you talk about, the 8%, that's not a very conservative and tight yield, but you're saying this is a really conservative investors should play here?
I think so. I mean, if you look at how they're generating those yields, so for example, they're buying very high quality lending club loans, and then they're levering them up relatively aggressively, let's say perhaps 200% debt to equity leverage. And then they're also, taking some loans in the US SME space, also the UK SME space. And then they're also going to, the likes of RateSetter and Zopa, and basically, focusing on higher risk, higher return loans. Now, to kind of someone unfamiliar with marketplace lending, that might sound like quite a risky proposition. However, if you look at these asset classes over the last 10 or 20 years, and basically backtest, and backtest is something that always raises kind of question marks. But I actually think if you look at the historical data of these asset classes, it's very difficult to envisage a scenario where the returns are anywhere close to zero or negative from the P2P fund. And therefore, in my view, it is a very attractive investment from a risk-adjusted point of view.
So even though, you talk about leverage and conservative, those two, there might be some people who would disagree, but I guess my question is, for this particular entity, the closed-end fund, you get another financial crisis, you still believe that they won't have negative returns?
I do, because if you look at consumer finance in general, if you look over the last 10 or 20 years, the returns have been on average about 8% or higher for consumer finance in general. So the type of loans that the P2P fund is leveraging up are the higher quality consumer finance loans. So if you backtest that credit grade of consumer finance loans, it's essentially bulletproof, unless you think we're going to go through, a 1 in 200-year global financial crisis. And then at that point, all bets are off. But, even if you went through the last global financial crisis, which people say is the worst in 100 years, this particular strategy would have performed very well.
Okay. So, what we've seen in the US, a dramatic increase in institutional investors coming into the space. It's starting to happen in the UK. We've seen yields come down a little bit in the US. What is the impact on yields going to be, and what can you just maybe look into your crystal ball and say where are yields going? There's been definitely a disparity between the two countries, and I want to know what you think where it's going.
Yeah, I think that's a good point. I think we'll see a little bit of margin erosion in the US, just because, particularly in the peer-to-peer space, because there's so much institutional capital just woken up to the attractive risk-adjusted yields available from Lending Club and Prosper. I think more broadly in the US, direct lending platforms, which is to say platforms which don't take resale money, still offer very attractive double-digit net yields to institutional investors that are willing to go, let's say, slightly off the beaten path, away from Prosper and Lending Club, towards some of the direct lenders which have gotten less attention. And frankly, I don't want to disclose which ones they are for proprietary reasons, but there are a lot of very attractive yields out there. I think in the UK the picture is slightly different, because historically there's been very little institutional capital in the UK. It is coming into the UK currently, and that's giving the platforms confidence to go up the risk curve a little bit, and therefore they're getting better net yields on average. I think in the medium term in the UK, the picture will change radically. I think as the ISA money comes into the UK market, as we were talking earlier, I think you'll see a flood of capital chasing a relatively constrained pool of consumer finance loans. And I would expect net yields in consumer finance in the UK on, let's say, a 5-year view to plummet, frankly, down to, pick a number, 3%, 4%, or possibly even lower. And at that point, I think people will get very interested in the marketplace lending mortgage opportunity, because people will realize that's the only way to balance supply and demand. And I think LendInvest is a very interesting platform in that respect, because they will have the technology and the processes to effectively serve the mortgage market in the UK.
Interesting. So you think the flood of investor capital is not so much going to come from institutionals, it will come from retail
in the UK
for retirement money.
Yeah, because I think as the government makes this ISA capital available, just basic supply and demand implies yields are going to fall very radically.
Interesting, very interesting. Okay, I know you've got to go in a few minutes, but I wanted to talk about IPOs, and let's first talk about the Lending Club IPO, which we talked about 8 months ago when we chatted, and you gave a valuation of $6.2 billion, which at the time I thought was a little high, but maybe now it's not. Are you still holding to that valuation?
And to be honest, I haven't done a ton of work on Lending Club recently. I would expect Lending Club to be worth something of that order. I think we still have a bet on a $5 billion.
We do.
We're going to be looking to collect.
I'm probably going to lose that bet, yes.
Collect on that in the near future. I think in terms of, other IPOs, obviously we've got On Deck. And then in the UK, a lot of people ask, which will be the next platform to IPO. I actually think LendInvest could be the dark horse that actually IPOs first. I think, the management there, really get the opportunity, the value of building a brand by being a publicly listed company. And, it's a fantastically profitable business, LendInvest. So I would not be surprised to see LendInvest actually first out of the gates in the UK.
Right. What about like Funding Circle, Zopa? They're obviously the names that most people will think will go first. What's the time frame on when you think they might go public?
Difficult to say. Normally platforms are very tight-lipped actually about their plans, and I think it's difficult to say. But my bet actually would be on LendInvest.
Really? Okay. Well, on that note, I'll let you go. I appreciate you coming on the show, Cormac. Thanks a lot.
Okay, thank you.
Okay. In many ways, we're very lucky in this country, I think. We've been able to invest in Lending Club, Prosper, other companies in online lending, we've been able to invest through our IRA for many years. The same isn't true in the UK. ISAs, this is really the equivalent of the IRA in the UK. That has been a vehicle that's not been allowed into this sector, into this asset class, and that is going to change. And that was one of the things I thought was fascinating that Cormac said, was that he expects such a flood of money to come in, not from the institutional investors, but from retail ISA money into this, and that's going to drive down yields. Be very interesting to see that. The consultation period is still going on. People are saying 2015 is the year when this is going to happen, and if it does, we will obviously all be watching very, very closely. Anyway, on that note, I will sign off. Thank you very much for listening, and I will catch you next time. Bye.